Hello, good morning, everyone. Welcome to all of you for today's session. So, students, we are proceeding towards the practice questions of audit risk. So, audit risk, I explained these things yesterday. So, once again, a quick review of the same. So, when you are going to explain audit risk, something as audit risk, you must have to link it to with some assertion being affected. You have to link with that, or you have to explain understatement or overstatements of any financial statement items being specific. What is the case? Or the third, or internal control, sorry, inherent risk, control risk, or detection risk. So these are the three ways in which way you can explain audit risks. Now, next. So then there is audit response as well. The audit response, what audit response is? Audit response is a direction of work. And the direction of work can be in the form of test of controls or in the form of substantive tests. Means you have to tell which approach auditor will use. Auditor will be using. You have to tell that. And when you are writing a response, you have to be clear that it must address the risk you are identifying. Okay, and the second thing, you have to a bit explain it, the approach. You will not say increase substantive tasks or like that. Rather, you will have to a bit explain it. Now, so let us start practice questions on the same without any delay. Students, before I proceed towards practice questions, there is another thing about audit risk. And what is that? There is another thing that audit risk, when we say audit risk assessment, it is also done by analytical procedures. Again, audit risk assessment is also done by one way to identify risk of material misstatement in financial statement is using analytical procedures. That you compare the things just like that. I explained this point yesterday. Here it is. Yes. Receivable days has increased. So this is analytical procedure, comparisons, ratios. From this to this, hence struggling to pay. Similarly, you may find in the exam that gross profit margin is there given and net profit margin is given. Gross profit margin is increasing, net profit margin is decreasing from the previous year. So gross profit margin increasing and net profit margin decreasing. When we talk about it, gross profit margin and net profit margin decrease. So there is an issue that what might be the risk? There might be inappropriate classification of costs. There might be some direct costs which have been charged to indirect costs. Or there may be some costs which may have been omitted simply. So this hence profits are misstated. So you see here misstatements, how to link that. And we will be doing its question today. So one by one, let us start with it. Starting from March, June 19, past paper. March, June 19 past paper. So it is question 17B, page number 10. Yes. So page number 10 of the handout. Yes, here it is. And you can see the first part is knowledge based. Quite easy. Copy paste from the notes or the book, whatever you have covered. So here, the second requirement is explain 8 audit risks and describe audit risk and explain auditor's response. So 16 marks. 16 marks it is. So students, I told you in the last class yesterday that audit risk, anything because of which financial statements may be misstated, that is audit risk, and detection risk as well. So students, 8 audit risk, I will give you 6 minutes in exam. This much time, that 5 minutes maximum you have to use while reading and analyzing the scenario. So please go through it, analyze it, and then we will solve it. Be quick, everyone. Yes, I hope you have gone through it. Tell me, please, have you gone through it? Now, you are an audit supervisor of Daffodils Company and are planning the audit of Peony Company for the year ending 31st May 20x9. The company is a food retailer with a large network of stores across the country and 4 warehouses. The company has been a client of your firm for several years and the forecast profit before tax is 28.9 million. The audit manager has attended a planning meeting with, yes, has attended a planning meeting with the finance director and has provided you with the following notes of the meetings. Peony Company has internal audit department which undertakes control testings across the network of stores. Each store is visited at least once every 18 months. The audit manager has discussed with the finance director that that they may rely on the control testing taken by internal audit. Yes, they may rely. Now, student, the problem is that over here, this is detection risk. This is detection risk. How it is detection risk? Because internal auditor is performing work over there, and internal auditor is internal department of the company. It is internal department of the company, and external auditor, audit manager, they say we think we are going to rely him their work. We are going to rely on their work. When they are placing reliance on, that if you can recall, auditor has two approaches. One is performing substantive test directly, detailed substantive on financial statements. The other approach is they perform test of control, and if controls are effective, then after that, if controls are effective, then less substantive. Now, if they are going to rely on the testing performed by internal audit department, so it is possibility is that they may depend wrongly on the poorly performed work by the internal audit, poorly performed work, and hence they may perform insufficient substantive testing, resulting in the audit detection risk. Now, let me write it there. So our question is, it is 17B, September, December 19, question 17B. So here it is, audit risk and audit response. Yes. So the first risk we have identified here is yes. So audit manager, this is unnecessary. We say audit team or audit firm or external auditor, yes, may rely, it's better, which is undertaken by the internal audit department. If internal auditor has not performed control testing properly, then placing a reliance on the conclusion of his work, because after testing the control you conclude controls are effective or ineffective. If they are effective, less detailed testing. If they are not effective, more testing. So placing reliance on the conclusion of internal audit work will create detection risk, as auditor may not perform substantive tests properly because of reliance on internal audit work. Yes, you can write here poorly performed. On poorly performed internal audit work. Yes. So you see here, if they have not, so this will poorly performed work, it will create detection risk. Now, how it will affect auditor? How it is detection risk? He may not perform. Yes. Because of properly means you can use word here, may perform, again you can write here in another way, may perform insufficient substantive procedure. Insufficient for substantive tests on financial statements. Yes. Now, so now this is the risk. That what is the risk? The risk is that student detection risk arising from here. The feeling is that he may not perform work properly, poorly. This is the issue which is causing the audit risk. So we need to check that. We need to check that. We need to evaluate that. Yes, we need to evaluate that. And how do we evaluate that? So sorry, response should address it. So evaluate audit work of internal audit on control testing. Yes, that the work done by internal audit is adequate to be relied upon or not. So you see here, response should address the issue. This is the issue causing the risk, detection risk. Clearly. So we said this is approach, evaluate audit work. You can amend it. You can amend it. Perform audit procedures both ways. That was also correct. So just you are familiar with what I'm using the on if yes internal audit. Just 1 minute. On the work of yes. Is that clear to everyone? Tell me. Is that clear? So this is detection risk. I told you detection risk may be 10% in the exam. 90% will be the risk of material misstatement. This is detection risk, right? This is detection risk. Now, let us proceed further. Let us proceed further to the next part. Yes. During the meeting, the finance director provided some forecast information. Revenue for the year is expected to increase by 3% as compared to 20x8. Okay, now, and the gross, this is analytical procedure result they have given themselves. In exam, sometimes we have to calculate the ratio ourselves. Gross margin is expected to increase from this to this, and it is falling. You see here, same example I quoted a few minutes ago. Gross profit margin is expected to increase from this to this, and it is falling. The other is falling. Now, students, the risk is that one person, yes, the risk is that some costs from direct costs may be omitted or included in operating costs. Operating costs resulting in understatement of cost of sales and overstatement of operating profits, operating expenses. You see here, focus here, how logical it is. They say this is, we know that sales minus cost of sales. We get gross profit, then operating expenses deducted, and then we get operating profit. So they are saying that gross profit margin is increasing. Increasing means that this cost may have decreased. Either some cost is omitted. If it is increasing, some costs are omitted or some misclassified as operating expenses. That's why it is falling. So you see here, I have discussed the both. So risk, this is the risk. You see here, one thing should be clear. This is the issue. This is the issue causing the risk. Now risk, this is risk. What is the risk? What factor? What may have done? And this is the impact on financial statements. What may be understated or overstated? So this is purely risk of material misstatement we are discussing. We said audit risk has two parts: risk of material misstatements and detection risk. So issue, risk, how it arising, risk, how it is arising, and impact. This is the impact. So then our procedure should be on the risk. Response should be on the risk. So this is issue, This is risk. And this is impact. Yes, impact on financial statements. So these three are the things. You see how to elaborate, how to describe a risk. A risk, how it is arising. How, yes, what is the risk? How it is arising? And this is the issue. You can see. So this is basically explanation. This is explanation. Describe risk. This is identify. Now, our response will always address, we said cost may have been classified. Yes. So, now substantive test, we can apply over it. Compare breakup of expenses included in cost of sales and other expenses with the last year and investigate any difference. Yes, compare the cost included. If there is difference, investigate. If there is difference, investigate. Now, next. Peony company values inventory in line with industry practices, which is used to selling price, which is to use selling price less average profit margin. The director consider it to be close approximation to cost. Now, this is the problem. So, this is the problem. Now, students, as per IAS 2, as per IAS 2, inventory should be recorded at lower of cost and NRV. The method used by the risk is that method used by the company may not reflect this criteria of IAS 2. This is risk, resulting in, now we cannot say over or under. Can we say overstatement of inventory or understatement? So anything resulting in misstatement, because we are not clear. In any way it can move. Misstatement. You can write over or understatement. Both are correct. Of inventory in financial statements. You see here, risk. This is, I developed the point, risk. And then impact. Yes. I hope it is clear. I hope it is clear. Now, next. So what is the Now student, what students writes? What student write? Students, student do not explain it well properly. So the risk is that this may not reflect the criteria. Now, so audit testing should be performed to verify selling price less cost to sell of inventory is in line with IAS 2 criteria, that is lower of cost and NRV. Yes, another person can write it. Another way it can be right. Perform audit work to verify cost and NRV of inventory. NRV, yes, that goods are accurately valued in financial statements. So both are correct. The issue is about valuation. Now, next. You see, both responses are addressing the same risk. Both responses are yes. Now, the next point, come to the question. The company does not undertake a full year-end inventory count and instead undertake monthly perpetual inventory count, each of which covers 1/12 of all line in the store and the warehouse. Again, this is a point. Again, this is the point. As a part of the interim audit, which was completed in January, an audit junior attended a perpetual inventory count at one of the warehouse and noted that there were a large number of exceptions. Yes, where inventory record showed a higher quantity than physical inventory which was present. When discussing these exceptions with the financial controller, the audit junior was informed that this had been a recurring issue. Now, so students, this is the recurring issue. So the problem is that perpetual inventory count. Yes. Audit junior attended perpetual count. Yes. Recurring issue. So, students, the whole point is that If this is the case, the likely chances are that inventory may be overstated in financial statement at year end because there was a recurring issue. Yes, because inventory will be in financial statement will be based on record. Based on record. Now, so this issue, the issue is that this is the issue. The issue is that record is not updated. So the issue should be discussed with the management as count record is not reliable as perpetual, yeah, as inventory record, inventory record, as inventory record is not reliable. Now, so students, and a full inventory count may be required. Now, inventory count once again, because your record is not reliable. Inventory may be overstated. Because the problem is there. Just 1 minute, please. With the record. So record is not reliable. Now, next. So automatically, remember, here is the risk. We said risk. Here clearly misstated. Here clearly misstatement is there. You know, two things are there. Two types of issues are there in that scenario. One where we say there is risk that it may be overstated, misstated. But there are clear indication where there is no risk, where there is misstatement. Where there is misstatement. I repeat my words. In exam, there may be two types of points. One, where we say, for example, cost may be misclassified, may be misstated. Inventory may be overstated. We are doubtful, we are saying risk. So check, verify. The other is, they say record is not appropriate. Hence, it is misstated. So what should be done then? It should be addressed according to that. Now, next. During the year, internal audit perform a review of non-current assets physically present. Now, you see here one more thing. A number of, you see here, assets which had not been depreciated fully were identified as, again, another misstatement. Now, students, it means that depreciation method is inappropriate, useful life is inappropriate. So what happened? A number of non-current assets hence, student, the risk is that depreciation methods used by company was inappropriate. And that's why Assets may be overstated in financial statements. When because they are, yes, assets may be overstated. Inappropriate. So the risk is that it was inappropriate. And assets may be overstated. So now, risk. Discuss the depreciation method with management. You see, response to the risk. For non-current assets, and assess the reasonableness of the method used by them. Yes, so the risk is that. I hope it is clear. So risk addressed. So risk, you see, issue, risk, and impact, and you know that response. Now, next. The company has launched a significant TV advertising campaign in January 2009 in order to, yes, in order to increase revenue. So what they say, the director have indicated that at the current year, an current asset of 0.7 million will be recognized. Now, as they believe that advertisement will help to boost future sale in the next 12 months. The last advertisement to be shown on the TV is early May. Now, students, this is something blunder. Now, it is specifically set by IAS 16, it cannot be capitalized. So, students, let us solve it. Let us write it. The company has 0.7 million current asset recognized for its advertisement expense. Now, student, there is no risk. It is misstated. Now, so students, recognized in advertisement of shown on TV during the year. This cost needs to be expensed in financial statements, and if it is not expensed, what will happen? Assets and profits will be overstated. Yes, will be overstated. Impact. You see, I have not told here any risk, because it is clear cut. This cost issue, it is clear cut. Now, enquire the, yes, students, not inquire, it is cost, basically something wrong treatment we are saying. So simply request the management, when it is clear that wrong treatment has been done, what is the response? Request them to management to remove 0.7 million from current assets. and record that as expense in profit and loss. You see here, I repeat my words. Where there is wrong treatment, clear cut, we will say like that to correct that treatment. As an auditor, we will request them to correct it. This is another exception. Now, next. Six risks have been identified and discussed. Total 8 have to be done. Now, the next point is, during the year, here it is. Pioneer Company decided to outsource its payroll function to an external service organization. The service organization handles all elements of payroll cycle and sends monthly report to Pioneer Company which details wages and salary. Pioneer maintained its payroll record till 31st December, at which point the record was transferred. Yes. What is the risk? What is the risk? Now, the problem is that detection risk. Detection risk. Because auditor may not be able to obtain evidence for the record which is available at outsourced organization. Once again, detection risk. Now, so students, over here, what I will do is had outsourced. I will copy it and then I can edit it. Pioneer Company outsourced. Outsourced its payroll function. Yes. Sorry. Ration. Yes. On. Yes. Now, outsourced. So the risk, detection risk arises. Detection risk arises as auditor may not be able to obtain evidence about payroll which is being maintained by the service organization. Yes. Now, students. So now how to? The problem is that they may not be able to obtain evidence. Detection risk arises. So now, how to respond to this risk? So contact the service organization. Yes, service organization. Yes. And their auditor as well. Both. To understand the processes used by them, by the service organization to maintain record of payroll, to understand the effectiveness of, better is the effectiveness of, how effective they are. You know, the whole meaning is changed by it. And yes, auditor can also request type 1 and type 2 report from service organizations auditor. Now, problem is that some of you may not know what is service organization, what are type 1, type 2 reports. This is a topic in your every book, service organization. So then when they outsource the department, so it is there. So you can go through that. Type 1 and type 2 reports are basically, these are the reports about controls and processes of the service organization. So response is here. Now, next. The next point is here. Peone is planning to expand the company by opening 3 new stores during July 2009. And in order to finance, the company obtained 3 million bank loan, which is payable in area over 5-year quarter installments. In quarterly installments. Now this is straight away risk of material misstatement. Straight away. So students, how it is a risk of material misstatement? Can you tell me? Can you please tell me? That it is payable in 5-year quarterly installments. Can you tell me how it is a risk? Anyone would like to explain? Tell me please. Anyone out of you? Yes, anyone? How misstatement can arise because of it? Any risk attached to it? It is common sense question, by the way. It is common sense question, by the way. Anyone out of you? Please do let me know. No, I'm saying what can be misstated. No, it is not about that. What is risk of material misstatement? Exactly. Exactly. So bank loan should be, this is the point by Lakshmi, which has been explained. This should be split between current and non-current liabilities. Should be split. The risk is that, yes, liabilities will be misstated. If the risk is that if not correctly classified, liabilities will be not only current. In any way, it can happen. Misstated, exactly. So what is the response to that risk? So Reperform. Recalculate the split of loan into current and non-current liabilities. To verify management calculations of the same. Calculations and the same are correct or not. Yes. Now, students, the next point is, in preparation for expansion, the company is looking to streamline operations in the warehouse and is planning to make approximately 60 employees redundant. Yes, after the year end. No decision has to be made as to when it will be announced, but it is likely to be in May 2009. What is the year end? Year end is 31st May. Yes. Now, company is planning after the year end. Company is planning to make 60 employees redundant. Announcement is likely to be, yes. If this announcement has been done during the year, or it is done during the year, as per IAS 37, a provision for redundancy is required to be recorded in, yes, will be required. The risk is that they may not have done so. The risk is that they may not have done so, resulting in understatement of and expenses. Yes, understatement. Now, actually, two issues are there. Announcement has been done. Then, so students, inquire from the management whether announcement of redundancies have been done during the year. If so, yes. Now, students, now, if so, now calculation of provision. If so, review the relevant documentation Review the relevant documentation and recalculate redundancy costs to check it is correctly recorded by company. Now I will discuss one point here. What mistakes students do over here? For example, instead of writing the whole procedure, what they do? Whole response. What they do? They say perform audit procedures that redundancy provision has been recorded correctly. So means you are not giving an indication how to, on which performed procedures. So make it specific. Procedure by reviewing relevant documentations. Discussion with management. Means a bit hint is necessary, essential. If you do not write it, you will not get any mark. If you write only perform audit procedures, remember you will not get any mark. You will not. Tell me. Got this point? Now, let us proceed further. More questions. So how many points we have written? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 we have written. 8 were required. Anyways, now, next. The second is September, December. Sorry, this is March, June 19. Sorry, this was March, June 19. Yes, September, December 18. That is page number 33. Page number 33. Yes. Students, any question so far? Do let me know, please. Any question so far? Please let me know. Yes. Here is the question next. You can see. By the way, these two we have done yesterday. These two parts. Why analytical procedures are performed at 3 stages of audit? Why? Students, which 3 stages of audit? Number 1, at the planning stage, they are used for risk assessment to identify risk of material misstatement. At substantive tests, they are used to detect. At planning stage of audit, analytical procedure are used to detect risk of material misstatements. Now, second, as a part of substantive test, they are, here identify risk of material misstatement. They are here used for risk assessment. Risk identification, here they are used to detect misstatement. And the third is review stage of audit. We have to study it today. At the review stage of audit, they are used to, to assess whether financial statements are consistent with auditor's knowledge of company, and to determine whether appropriate work has been performed or not. Financial statements are consistent with auditor's knowledge of the company. 3 stages, 3 marks. You have to explain, simple. Calculate 3 ratios for both years, which would assist you in planning the audit of their G-Link company. 3 marks, 3 ratios need to be calculated for both years. And the next is, using the information provided above and the ratios calculated, describe 8 audit risk. Once again, you see 16, the 33, 19, 3, 22. So audit risk, 3 ratios and audit risk. So you have again 6 minutes. Go through it, analyze it, and then I will solve. Yes, please. Now, so students, they say calculate three ratios for both years. So that is not a difficult task. GP margin can calculate for both years. Inventory days, receivable days, payable days, we can calculate. Current ratio, quick ratios, we can calculate, and it is not difficult at all. So, acha. Okay, now next. So students, inventory days we can calculate. That past paper is, that is September, December 18. December 18. So inventory days we have to calculate, and the years are, yes, 20x8 and 20x7. So yes, here it is. We can, yes, 20x8 to x7. Now, so first of all is that is inventory days. How to calculate? We know that that is cost of inventory divided by cost of sales. So here it is inventory. You see here that is 1850 divided by 12440 cross 365. Yes, we can calculate it. That is 1850 divided by 12,240 cross 365 for the year. That is 54 days. 54 days. Now, here it was 1330 inventory divided by 10,800. So 1330 divided by 10,800 cross 365, that is equal to 45 days. So inventory days are increasing. Inventory days are increasing. Now, no, okay, I typed wrong. Yes, I typed wrong. No issue. Yes. Okay. Now, the next is that is receivable days. Receivable days. That is average receivable divided by 2750, 19 and 50. 2750, 19, 850. Yes, 19,850 cross 365. That is equal to 51 days. Yes. And here is, that is 1780, 16,990. So 1780 divided by 16,990. Now cross 365. That is equal to 38 days. Now, next. Three ratios they said. The third, we can calculate payable days. Yes. That is equal to average payables. That is 1970 divided by 12 cost of sales. That is, yes, 1970 divided by 12,440. Yes, sorry. Cross 365. That is 58 days. Now, the next is, that is 1190 divided by 10800. 1190 divided by 10800 cross 365. That is equal to 40 days. Now, so three ratios they asked, we calculated three. Now, next. The next point is, that is, but remember, students, listen one thing. Even if they had not acquired in the question, for example, it is not, there is no requirement for this. They have given this information. Still, we have to calculate ratios to identify risk. This part. Okay, we have to use that. So more ratios we need to calculate it. For example, current ratio and quick ratios. So current ratios, assets, sum of these three divided by current liabilities. Current ratio. So that is equal to current ratio that is equal to current assets, current liabilities. Now, so you see here one thing which is quite different here. This is liability, negative bank balance. Be careful, it is overdraft. This is overdraft. Positive bank balance is a current asset. So these two are the liabilities here. Here these three are the assets. Got this point? Got this point or not? Tell me. Now, so students, here we will add these divided by these two. So 1850 plus 2750. 1850 plus 2750 divided by two things. That is 1970 plus 810. This is liability. Current ratio 1.65. Yes. I hope it is clear. Current ratio and quick ratio as well. We can calculate quick ratio. Again, you see here, inventory is not included in it. Inventory is not included. 2750 divided by 1970 plus 810. That is equal to 0.99. Here, in the previous year, current ratio. In the previous year current ratio, these three sum 1330, 1780, plus the third thing is, that is 560 divided by 1190, that is 3.08. And quick ratio. What is quick ratio? So we will just remove that, take only this, because inventory is not part of that. That is equal to 1.97. I hope it is clear. So these are the ratios we need to use. So now second part is audit risk and response. So part B. The question number is basically it is 16. Question number 16. Here, audit risk and response. Now, students, I am just thinking how I can involve you in it. Just like we were writing procedures yesterday, similarly, what can we do today about it? I was just thinking about the same. Yes. Now, let us proceed and read it. So before I proceed, okay, let us read it. We may get some information about inventory, about receivable from the scenario as well, and the liquidity as well, because we have calculated these ratios. We may find some information from the scenario as well. You are an audit supervisor of Earl and Company and are planning to audit the Darjeeling Company for the year ending 30th September 20x8. The company develops and manufactures specialist paint products. Now, and has been a client of your firm for several years. The audit manager has attended a planning meeting with the finance director and has provided you with the following notes of the meeting and financial statement extracts. You have been asked by the audit manager to undertake preliminary analytical procedure using the financial statement extracts. During the year, the Darjeeling Company has spent 0.9 million, which is included in its intangible assets, on the development of new product lines, some of which are in early stages of development. Now, so this is the first risk. This is the first risk. Now, so company has Darjeeling Company, so just has spent, yes, has spent, has capitalized, because included in intangible asset, capitalized. Yes, so this word will need the 0.9 million cost on the development of new products lines. Yes, so then they have capitalized. Now, students, as per IF 38, as per 38, IS 38, research cost needs to be expensed and only development cost can be capitalized. Can be capitalized. Can be capitalized. Yes. The risk is that they may have capitalized research cost, resulting in overstatement of profits and assets and understatement of expenses. Yes. Now, so students, so risk is that they may have capitalized research cost. So now, response, obtain a breakdown of 0.9 million and verify that cost details whether it relates to development of products and it does not include any research cost. You see here, does not include any research cost. So you see here the response on the same. Response on the risk. Now, next. The next point is, additionally, the company is looking to expand production during the year. It purchased and installed a new machinery line. All costs incurred in the purchase and installation of the cost has been included property, plant, equipment. These capitalized cost includes purchase price of 2.2 million, installation cost 0.5, 5-year maintenance, servicing and maintenance cost of 0.5 million. Now, so they have capitalized all these. Now, students, this servicing cost is not related to the cost of bringing the asset into its working condition as per A16. It should not have. So this is misstatement. Sorry. We will not say this is risk. We will say it is misstated here. Here we are. Yes. Now, we will simply write it here. The company purchased and installed included cost of the asset purchased yes. Now, students, as per IAS 16, servicing cost is not the cost directly involved servicing cost is, just a minute, please. Directly involved in bringing the asset to its working condition. Yes. So it should not have been included in the cost of asset. Rather, now it is a bit technical, it should be charged to profit and loss over 5 years. Over 5 years. Yes. So a part of it should be charged this year to profit and loss, and remaining should have been recognized as prepayments. Yes. Hence, so what is the impact? You see, I'm not saying risk. Hence, assets, you see, property, plant, equipment is overstated. And profits, both, because they have not recognized, and profits are. And what is understated? Prepayments are understated. Impact. You see, directly we say it, we are not saying here maybe or likely. We are directly saying that they are. Yes. We are directly saying wrong treatment. Now, next. I hope it is clear to you people. I hope it is clear. Now, students, our audit work, this is wrong treatment. What we will do? Discuss the accounting treatment with the management, accounting treatment of servicing cost, and request them to remove it from property, plant, and equipment. Record it as prepayment and part of it in profit and loss for the year. Yes. Do that. Is it clear to everyone? You see, again, wrong treatment, we are not saying check it is correct. We are asking them to correct it. Where treatment is wrong, we have to tell them to correct it. Now, next. clear. Now, let us proceed further. In order to finance the development project and new manufacturing line, the company borrowed 4 million from the bank. Finance the development projects and new manufacturing line. Yes. Students, now what is the issue? What is the issue? Which has to be repaid. We know that. We all know that. We have solved one point regarding it. The risk of wrong split. The cost may not have been splitted properly. Not cost, we say loan. In current liability and non-current liability. So the company borrowed, I will copy it from here, this point. $4 million from the bank, which has to be repaid. Yes, you see here, we have done it already. Now, simple is that. Simple is that. May not have been properly. Now, so students, now what is the, so review or you can say recalculate the split of the loan between current and non-current liabilities to verify it has been recorded correctly by the management. Yes, simple is that. I hope it is clear. I hope it is clear to you people. Now, this is wonderful point. Wonderful point. By the way, you can write a point for 5% interest as well. They say 5% interest is there. The risk is that they may not have calculated interest properly. And interest expense may be understated. Profits may be overstated. So auditor will recalculate the finance cost and verify it has been correctly recorded in the cash book, in the profit and loss account or not. You can do that. Quite easy. Now, The company started a number of initiatives during the year in order to boost revenue. Sorry, this one I missed. Student, how it will be an audit risk? Anyone? Please tell me. Anyone how can tell me how it will be an audit risk? Yes. The point I have highlighted, what do you think how it can be audit risk? These points, this point I have highlighted, I'm asking, not developing stage. Exactly. There is inherent risk. Exactly. So, company is going to, yes. So, I will simply copy it from here. Company intends to undertake a stock exchange listing in the next 12 months. Yes. So, in order to present a good picture of company or picture of performance to the stock market, the directors may overstate assets and profits for the year and understate liabilities. Yes, possibility is there. Profits, revenues as well you can write. Assets, revenues and profits. Understate liabilities and costs. Possibility is there. They may manipulate. Now this is general risk. So what is the so overall response? Assign experienced team for audit, increase professional skepticism and perform detailed audit work on assets, profits, revenues, liabilities. Recorded in financial statements for the year. Yes. Simple is that. Now, next. The next point is, yes, the company has offered extensive credit terms, increased. You see here, it has offered extended credit terms to increase sales. So you see here, we will write it here. And receivable days have been increased from, you see here, 38 days to 51 days. 38 days to 51 days. You see, we have to utilize that as well. So students, there is risk that there is increased risk that provision for doubtful debts and bad debts may not have been charged to reflect increase in receivable days. So we can say here, we can write one thing. This increases the risk of recoverability of receivables. Now, and so here, this is basically audit risk. Now, so how to respond it? So students, how to respond it? We say that provision for bad debts and doubtful debts and bad debts may be understated and provision may be understated and receivables may be overstated. Now, what is the audit response? Yes. So review aged receivable, ledger of the company to assess the adequacy of provision for doubtful debts recorded in financial statements. So direct assessment. Now, next. So the next point is, student, is it clear? Is it clear so far? Any question, anyone? Everyone is silent. Either you are getting everything or you are only blank. Yes, tell me. Are you getting its understanding? Now, next. Good. Let us proceed further. So now I will ask you to write something as well. So in addition, Darjeeling has offered a price promise. You see here. Which would match the price of any competitor for similar product purchased. Customers who are able to prove that they could purchase the goods cheaper elsewhere as are asked to claim the difference from their dealing within 1 month of the date of purchase via its website. The company intends to include a refund liability of 0.25. Now, which is based on the monthly sales, monthly levels of claim to date. Students, what is it? IFRS 15. It has specific provision. Now, they say that IFRS 15 says that whatever is likely to be refund amount, it should not be recognized as a revenue. Initially, do you see, they are initially recognizing as revenue. Initially, whatever is likely to be refunded, that should not be recognized. Now, so one thing. The second thing is that refund liability. There is a problem. Okay, let me write it. Let me write it. Yes. Competitor for similar products and refund and can claim refund. Yes. Now, you can write in another way as well. There is one, there are two ways to discuss it. One is that this involves this refund liability calculation is highly subjective. Judgment is involved. Highly judgmental. And the risk is that company may not have calculated that correctly, resulting in overstatement of profits, yes, and understatement of liabilities. Possibility is there. Possibility is there. Now, now how to respond this risk? How to respond? Very easy. Can you tell me how to respond this risk? Audit response? Can you tell me? Please. Can you tell me that? Anyone out of you? Anyone, please? What might be the response? What do you think? Anyone out of you? Not recalculate. This question, because it is assumptions. It is not something straight away calculation, please. Yes, what Lakshmi has told, that is wonderful. Yes. That is exactly. Remember, where judgment is involved, it is not about calculation. That calculation may be wrong. No, assumptions may be wrong. Fund liability figure and assess the reasonableness of the validity of those assumptions. Now, and calculations. Now, validity of those. Now, so students, the next point is here. The finance director informed the audit manager that problem arose in June 20X8 in relation to the material within the production process for one particular product line. A number of these faulty paints product has already been sold, and the issue was identified following a number of complaints from customer about the paint inconsistency being incorrect. A precaution further sale has been stopped and product recall has been initiated. Now, what is it about? Actually, sales refund to the sales. One issue, sales may be overstated, that may need to be removed when they are calling. A refund liability need to be recorded. Yes. So the risk is that they may not have reduced the sales amount by the product recalled. A refund liability may be understated and sales may be understated. Sale may be overstated. So what is the response? What is the response? So they say that the sale was made. Yes. It was issued in the June. So obtain the information about the faulty paint made in the June and afterwards, and verify the sale has been removed from the revenue and a refund liability has been recorded at correct amount or not. Very easy, not difficult point. I would like you, first of all, write audit risk. Explain. Write, please. Explain how you will write about it as audit risk? Be quick, everyone. How will you draft it as audit risk? Be quick. This issue. I have explained, but you have to draft that. Be quick. I'm waiting for your answer. Everyone has to write it. I am waiting for audit risk from your side. Audit risk. I'm saying again, you have to explain audit risk because I am receiving response, not risk. And this is quite weird to see. I think I myself need to solve it because I'm not receiving good response from you people. Okay, some of the answer I have received, I will check those. These are the answers I received. Another received. Okay, now I'll respond. Here, please, everyone. So the issue was that I will copy the issue as well from here. This was the issue. Now, to the first I received here, the risk is that revenue related to the product may not be removed from the sales, resulting in overstatement of revenue. Very good. It's correct. So this is the response. I didn't ask. It was not required. As there was a priority call, the sale rate should be eliminated. Very well done. Very well done. Absolutely correct. Now, next. Discuss with management the impact of faulty paints. No, this is quite generic. Which provision should be provision for what? Nothing specific. Wrong. Not clear. Too generic. Again, this is response, which was not required. A number of faulty has already been sold. This is priority call has been initiated. The risk is that included, and hence what may be misstated? Refund liability issue not discussed, incomplete. No. Inventory after the incident. Which inventory? Faulty paints. Mention specifically. Then it will be correct. Very good. Very good. Absolutely. So you see, this answer will not get any mark because there is no explanation of the issue, no linkage. How it has been developed, this is a wonderful answer. Absolutely correct. This answer is absolutely correct. These two answers. Yes. So this is also correct, but a bit explanation like this is required. I hope it is clear. So what is the response then? So I will simply copy it. Yes. I will just copy it from here. Yes. Sale for faulty paint has been stopped. So this is the risk. Now, what is the response? Now, verify the amount of faulty paint sale made in June and afterwards, and check that it has been removed from sales of the company. Sales of the company, and has been included in closing inventory. Inventory for the year. Inventory at the year end. Now one more thing, you can say the refund liability may need to be created. No one has discussed that. Refund liability is required, which may not have been generated, which may not have been created. So you can write so if you discuss that, that is also correct. That is also correct. Now, so now I will be asking you people to write answers, because what I see, you are unable to write. At least you tried one thing, and although you are facing a hurdle, but it will be improved in this way. Now, so the next point is cash issue, current ratios, quick ratios, inventory valuations. So now we have calculated these ratios above. Inventory days have increased from 45 days to 54 days. Now, so 45 days to 54 days. Inventory days have been increased from 45 days to 54 days. So it is taking more time for being sold. Yes. So it is indication of slow moving inventory, and its value may have reduced in the market. The risk is that is that it may not need to be written down and may not have been recorded at lower of cost and NRV, and hence inventory may be overstated. Yes. So risk overstatement of the valuation. Now very easy. So perform audit work on NRV inventory on line by line basis, each line basis. Yes, that it has been valued correctly and at lower of cost and NRV. Yes. Now NRV. I hope it is clear. I hope it is clear to you people. Now, the next is cash. Cash issue. Liquidity issue. We have calculated that. Liquidity, we see payable days have increased. Current ratio is falling. Quick ratio is also falling. Okay. And you see here, one more important thing was in the question, which was overdraft. Liquidity. Positive balance have turned into negative balance. So this is indicating that. Now let me tell you, these are easy marks. How to score these marks? For example, how we will write? We write in this way. Current ratio has fallen from this to this. Quick ratio has decreased from this to this. Yes, you will write in this way. The both you will mention. Moreover, payable days have increased from this to this. You will mention those days. And the last thing, a positive bank balance of this amount has been turned into negative bank balance. Must write overdraft of this amount. So you just write what we have seen. Now, how to develop it as audit risk? It indicates that it on all these factors. Indicate that company is facing cash flow problems. Cash flow problems. And there may be some going concern, uncertainties uncertainties. The risk is that. Now, how it is, now, if you write this only, this is not audit risk. Now, this audit risk is, the risk is that going concern, that uncertainties to going concern may not have been disclosed properly in financial statements. Now, what is audit work? Going concern. So, perform audit work. Perform detailed testing on going concern of the company. And assess the validity of assumptions used for going concern by the management. Now, that's enough. You can write another work procedure, review whether any going concern uncertainty has been properly disclosed or not. So in this way, you will explain it. Now, that's it. Students, now it is time for a 15 minutes break. After 15 minutes break, we will be back. Today, a lunch break will be a bit late. You know, late than yesterday. Okay. In 15 minutes, if you can have something, some junk food or some biscuit or like that, do have that. So because okay, so see you after 15 minutes break. Yes, hello everyone. Let us start it. So, here is the question which we have to do. That is March, June 18, page number 49. Yes. Once again, the knowledge-based question, 4 marks, responsibilities, and 8 audit risk, 16 marks. 16 marks. Read it, please. Take 5 minutes. Identify. Be quick, everyone. Identify audit risk. I am waiting for your response once you have done it. Be quick. Yes, students, I hope you have gone through it. So let us start it. The inventory is, I'm starting from here. Inventory is value at lower of cost and NRV. Lower of cost and NRV. Cost is made of purchase price and cost of conversion, including labor, production, and general overheads. This is the first issue. This is the first issue. Yes. So BlackBerry company. The next question is here. It is March, June 18. Yes. Here is audit risk. Inventory is recorded by, valued by the company. Yes. Students, the risk is that general overheads being included in cost of inventory may not be production related, resulting in overstatement of cost and valuation of inventory in financial statements. Yes, that may not be. That may not be production related. So, what is audit response? Discuss with management and obtain details of general overheads included in cost of inventory if they are not production related. Request management to remove those from value of inventory. Yes. Is it clear? Tell me, is that clear? Now, next. The next point is the company plan to conduct inventory count after the year end at the warehouses, you know, after the year end. You see, year end is 31st March. And adjustments will be made for movements post year end. That will be removed. Now, students, second issue. This is the second risk. What is the risk? The risk is that adjustments for post-year end movement of inventory may not be done, have been done correctly in year-end inventory, and inventory may be, now we cannot say over or under, misstated. That's it. We cannot say. So what is the response for this risk? What is the response? Now, so mark details of inventory and dispatched after the year end. After the year end. And verify it has been adjusted in the closing inventory at the year end. The inventory to reach at, to calculate in the inventory, to calculate accurate closing inventory at year end. Yes. Now, I hope it is clear. I hope it is clear. The next point is, during the year, BlackBerry paid 1.1 million to purchase a patent which allows the company the exclusive right for 3 years to customize their portable, now, music player to gain competitive advantage in their industry. The 1.1 million has been expensed. Now tell me, what is the issue? How will you explain this audit risk? Tell me. How will you explain? Tell me, students. Everyone. Your answer is right. It should be capitalized. But how you will write it? How will you draft it? How will you draft it? I am asking about the same, actually. Now, I will just copy it from here. Yes. The company paid 1.1 million to purchase a patent for 3 years. Now, has been expensed. As per IS 38, As per IS 38, this should have been recorded as intangible assets and amortized over its 3 years. 3 years. Amortized over its 3 years. Yes, hence, here assets are under asset and profit both, and profits are understated in this case. Now, request the management, it is wrong treatment. Discuss the treatment of rights with management and request them to record 1.1 million as intangible asset instead of, and remove it from profit and loss. Moreover, request them to calculate amortization charge for the year of the intangible asset. Yes, calculate and record in profit and loss. Yes. Question. Now, next. Because it is directly misstatement, in order to finance. Yes, in order to finance, what they have done, 1.2 million share that is. Now, BlackBerry raised 1.2 million. Now, what can be the problem? The risk is that amount raised may not have been recorded as share capital and share premium account properly, and these may be misstated. Now, verify that 1.2 million, verify that the split of 1.2 million has been properly recorded in share capital account and share premium account properly. Yes. You can write recalculate and verify. Yes, recalculate and verify. Now, Next point. In November, it was discovered significant teaming and lending fraud has been carried out. Yes. Teaming and lending fraud is there. And receivable balances may be misstated. So two things. Now, one is that, first of all, here, 4 team members of the sales ledger department has been carried out by employees. Yes, the risk is that there might be more fraudulent transactions may not have been identified in receivables. And hence financial statements, you know that, and receivables may be misstated. Possibility is there more. So now, increase professional skepticism and review and perform detailed work on individual receivable balances. For unusual accounting entries. To identify further frauds. Yes, receivable. Now, you see here, our response is directly towards the same. Now, next. The next point is they have stolen. Okay, the next point is, as a result of it, they have decided to outsource. Now it will be the problem of detection risk. We have solved one point like this in the previous question. Do you remember that? Do you remember? We have done one point like that already. Outsourcing. Similar point to us in the morning. So I'm not going to do it once again. So you can refer to the same. Okay? Because it will be just repetition of the same point. So just we need to request and the service organization's auditors report about their processes. Okay, right? So similar thing. So contact with that service organization to assess their controls, understand their processes. Now, so the next is In December 20, students, you can see one thing. There are some points which are being repeated again and again. In the yesterday, I point highlighted. Actually, what I observe is that when such a point is not well answered, examiner form the conclusion that majority students didn't solve this point properly. So they test it again. It is happening. So they repeat it. That's why these points have to be, done properly, so that if these are repeated, you should not be like that. You must be able to solve it properly. Now, next. The next point is, in December, financial accountant was dismissed. He has been employed by the company for 9 years and has threatened to sue for unfair dismissal. Now, what is it? It is probable, then a provision is need to be recorded. If it is contingent, if it is not probable, it is possible, then what should be done? Disclosure should be given. As per IS 37, the risk is that they may not have recorded it. Possibility is there. So, students, let us solve it. Let us write it. Now, yes, we will be doing it first. If the payment to the employee is probable, a provision is required as per IAS 37. A provision is required. Yes. And if it is possible obligation, then a disclosure of contingent liability is required. Risk is that company may not record the contingent liability or provision. Yes, in financial statements. Yes, may not record properly. Yes. So this is the problem. May not record properly, resulting in misstatement of financial statement. Misstatement, yes, simple is that. Now, we are not sure whether it is probable or possible. So then how to verify it? Yes. Review the correspondence. You can ask the lawyer directly as well, between company and their lawyer to assess the likelihood of success of claim by the financial accountant. Yes. Yes, first. So this is the first thing first. Then we will check the disclosures. Now, next. As a result of this dismissal and until his replacement commences work in April, the financial accountant, yes, so what is happening? They say that the financial accountant responsibility have been adequately allocated to other members of finance department. However, for this period, have been performed, reconciliation have been performed. So now, this is important. This is important. Due to the absence of him, yes, no, yes, when he was dismissed, when he was since December 20x7 and year end is 31st March. Since, sorry, since December 20x7, yes, has not performed. So there is increased risk of errors in payables. Yes, and payable balances may be over or understated. May be over or understated. Now, so what is the audit response? So increase testing. Yes. Detailed testing on trade payables. Trade payables. And request management to prepare a supplier statement reconciliations. And you know that review that reconciliation in detail to confirm completeness of payables in financial statements. Yes. Now, next. So students, I hope it is clear to you people. I hope it is clear to you people. So you see here, when they do not perform, so we will increase the testing. We'll ask them to prepare it at the year end. We will review for anything something unusual for completeness of payables. Students, is it clear so far? Tell me. 7 points we have done. 7 we have done. 7 points we have done so far. Now, Next point. I don't know why I'm not getting response today from you people. Yesterday, you people were active. Today, not that level. In January 2007, a receivable balance of 0.9 was written off by BlackBerry Company. Yes. As it was deemed irrecoverable, as the customer had declared itself bankrupt. Yes. So, in February 2008, the liquidator handling the bankruptcy of the company publicly announced that it was likely that most of the creditors would receive a payout of 40% of the balance owed. As a result, BlackBerry has included a current asset of 360,000 within statement of financial position and other income. Now, this is the problem. As per this amount, so they have written off now. So this is what is happening. So they say that publicly announced, the liquidator announced publicly. Liquidator announced. But there was no formal notification confirming that. So although it was a public notice by the liquidator to pay 40% of the debts, but there has been no formal notification received by the company from the liquidator of the customer. So it is not virtually certain yet that the amount will be received. So it cannot be recognized as asset, as asset. It cannot be. Yes, as asset, it cannot be recognized. So assets and profits are overstated. Student, is it clear to everyone? Is it clear to everyone? This point up till now, tell me, is that clear? Tell me, please. Yes, last day is the laziest day. You are right. Yes. Tell me, please. Is it clear? Okay, now. So now how to respond it? How to respond it? How to respond it? What is the way to do that? Discuss with the management whether any notice has received about payment from the liquidators of the customers. If not, request management to remove 360,000 from assets and profit and loss of the company. Yes. Now, this question is complete, students. This question is complete. Now, one more question we have to do, but just 1 minute. Give me just 1 minute, please. There is something important. Just a minute, please. Just 1 minute, please. So I have sent you in the chat box and a form, a feedback form. Take 2, 3, 4 minutes, fill it, please. Be quick, everyone. Fill it, please. Everyone, this is important for us. Yes. Be quick, everyone, please. Be quick, please. Be quick, everyone, please. This is essential to be done. Be quick. Still, people are have not done. Some of the people. Be quick, please, so that I can proceed with the next question. Okay, good. Now, let us proceed further. Thank you, everyone. Still a few remaining. I think they are in the way. They might be coming. Okay, now. So the next is, the next question. That is page number 61. Page number 61. Here it is. So 7 audit risks, an auditor's response to each. So now this question you will be solving one by one. Yes, and I'll be giving a response on that, because something should be done by you people as well. So anyways, take first of all 5 minutes, identify risk. Be quick, everyone, identify. Then I'll proceed to discuss it with you. Be quick. Students, I was waiting for something, I couldn't find in the previous question. 1 point, and which is again free marks. This one, this one. This is the point. New client. Whenever it is a new client, remember there is detection risk. Whenever it is a new client, there is detection risk. There is detection risk. Because auditor, now how it is there? Because auditor may not have the knowledge of the client, good understanding of the systems of the client, and the financial statements item. So auditor may not plan and perform audit work properly. May not plan audit work properly. Possibility is there. So then how to it to be written? So let me write this as well. So it was It was September, December 17. September, December 17. And the question number is 17. Yes. These are easy marks. Whenever it is a new audit client, it is an audit risk. So what I will do, Prancer Company is a new audit client. Yes, Prancer Company is a new audit client of, it is a new audit client of Cupid Company. Cupid Company is the firm. Audit firm Cupid Company may not be well familiar with accounting issues and policies of the Prancer Company. Prancer Company, it may not be familiar with that. Okay, and hence may not be able to plan and perform audit work properly due to this detection risk. Yes. Now, this is how you have to explain it. So now this is general, whenever we have such a risk, what we do? So audit response. Yes. Allocate sufficient or assign experienced team for this audit who should spend enough time to gain understanding company accounting methods at the time of planning of audit. Yes, answer. Student, these are free marks. 2 marks. Now, next. The next point is, that is, the prior year financial year recognized work in progress of 1.8 million, which has comprised of property construction, work in progress, as well as maintenance service for finished properties. Maintenance. Now, and work in progress. Students, you see here, work in progress. This is the whole issue. Now, students, this is the issue. Now, what is the risk? The risk is that percentage completion of work in progress may not have been calculated correctly by the company, and inventory may be misstated in financial statement, because over or under, anything can happen. Now, so what they should do now, review the stage of completion calculation. You see, substantive test calculation done by management and discuss the assumptions used for the same with the management and assess the validity of those assumptions. Yes. Assess the validity of those assumptions. Now, next. The August 2017 management accounts recognized 2.1 billion inventory of completed properties compared to inventory value has increased from the previous year. Yes. So let us write it. Inventory levels have increased. This increase in inventory may be because of, maybe due to the reason that company is struggling to sell the inventory. Possibility is that. And hence, its inventory may need to be written down and may be overstated in financial statements. Yes, may be overstated. Now, inventory is there. It is simply testing of cost and NRV. So, you can write any procedure about it. So, yes, perform detailed testing on NRV and cost of the inventory. Yes, to verify to assess whether inventory value need to be written down at year end or not. Now, next. Next. A full year-end inventory count will be conducted at 11 sites. An auditor may not be able to. Again, detection risk. There is detection risk. Sufficient team is not there. Now, so it is detection risk. Now, this is not sufficient audit resources. Hence, there is detection risk. Detection risk that auditor may not be able to obtain sufficient appropriate evidence. Audit evidence about inventory. Yes, may not be obtained. Yes. So then what should be done then? What should be done then? Identify warehouses with material inventory and attend inventory counts at those warehouses, and for others warehouses. For other warehouses, obtain the inventory count report containing any discrepancies identified during count and discuss those with management. So this is the audit approach. Identified. Yes. Discrepancies. Next. 4 points we have discussed. In line with industry practices, Prancer companies offer its customer a 5-year building warranty. 5-year building warranty, which covers any construction defects. Customers are not required to pay any additional fee to obtain the warranty. Yes. Now, the finance sector anticipates this provision will be lower than last year, and the company has improved its building practices. Now, Yes. Provision for warranty of the building. Yes. This is the issue. This is the issue. So, students, there is risk that there is risk that actual claims or actual quality of properties may not have been improved, and warranty claims may be of same level. But the finance manager or director, it is finance director, yes, may have deliberately reduced the provision, to manipulate profits, yes, for the year. Possibility is there. Possibility is there. So now, how to calculate the provision? Yes. Yes. Compare the actual claims, warranty claims, actual claims made during this year with the provision for warranty recorded last year. Whether it is same or reduced, actually is less than the provision. Yes, possibility is there. To assess the reasonableness of reduction in warranty provision this year. Yes. You see, specific scenario response should be scenario specific. Response should be scenario specific. Risk specific. Now, next. Customers who wish to purchase property are required to place an order and pays a 5% refundable deposit in advance. Students, tell me about its risk. Very quick, everyone. Tell me. What should be the risk here? Be quick, everyone. Be quick, please. What will be the risk with it? This point. How it is an audit risk? And hence, exactly, it should, the complete thing cannot be recognized. The risk is that they may have recorded it as revenue. Exactly. Now, next. Now, let us proceed. So, how to write it? How to write it? Here it is. Sorry, it has not been copied. Yes. These deposits should not be recognized as revenue as performance obligation has not been satisfied by the company. And should be, and instead, it should be recognized as deferred income. Deferred income. The risk is that management may have, you see how to write it, how to explain it, may have recorded this advance deposit as income at the time of receipt, resulting in the overstatement of profits, sales, and understatement of liabilities. Yes. Now, next. Now, next. So what is the response? How to respond it? So you see here, perform audit work on revenues to verify deposits, advanced deposits by customers are recorded as deferred income. Yes, deferred income. Yes, or not. Next. Now, allowance for receivable will be low this year. The finance director has informed you that although allowance for receivable have historically been low maintained, it is anticipated that this can be significantly reduced. This can be significantly reduced. Now, so they are reducing the, yes. So what is the risk? The risk is that receivable may be overstated. Yes, reduced. There is risk that management may be doing it deliberately and hence to improve financial statements and receivables and profits may be overstated. Now, discuss with direct finance director the reason for reduction in allowance for receivable and assess the validity of their response. Validity of their response. Yes. Now, so you can write another way as well. It is also correct. Obtain aged receivable ledger from management and review it to assess the reasonableness of allowance for receivables recorded this year. Yes. Now, next, the next point here. Prancer construction companies prior year financial statement in August contain a material overdraft balance. Okay, so we can link it with that as well, above information. We can link it. For example, they may have overstated. For example, we can say here, they may have reduced this provision to increase assets and increase profits to comply with this covenant, to comply with this, because minimum profit, we can say that, link that, we can link that. Now, so this can be said, okay, but there is another point. Yes. What is the risk? The risk is that covenant company may breach covenant attached to the with the overdraft and covenant attached with the overdraft and overdraft may become repayable, causing going concern problem for the company. And the risk is that management may have manipulated financial statement items to ensure compliance. Manipulated or misstated? Manipulated or misstated. To ensure compliance with the covenants. With the covenants. Yes. Now, so what auditor should do? Increase professional skepticism and perform work to check whether work on assets and profits of the company, because these are two covenants. Two covenants. Company to verify they have been recorded correctly by company, because yes, covenant is linked to that. Now, let us proceed. By the way, 8 have been done. 7 were required. 8 have been done. So the next is here, days. Payable days increased. So this can be linked with the liquidity issues again. Okay, so we have done this question. Now, students, it is time for lunch break. So 40 minutes lunch break. After lunch break, we will be back and we will be discussing review and report. We will be discussing that. One question is remaining behind that you should try at home. This we have not solved. All other four we have solved. Okay, so see you after 40 minutes lunch break. Yes, see you. Yes, students, audit report. Audit report. So audit report, this is standardized audit report in front of you. Standardized format. And it includes, that CAM, key audit matter paragraph. That what you have to memorize: title of the report, addressee, opinion paragraph, basis of opinion paragraph, other information, responsibilities of management, responsibilities of auditor, date, address, signature of the auditor. So you should know this content. Yes, these paragraph names and the sequence is important. This is important. So this is basically unmodified audit report. Unmodified audit report. Yes. Unmodified, standardized audit report it is. It is standardized. Now, so what is key audit matter? Key audit matter paragraph, it is part of the listed company's audit report only. Only. And it includes those matters, remember, which have been correctly, remember, key audit matters include those, just 1 minute, please. Yes. So basically we say key audit matters. What are these matters? These are matters correctly reflected in financial statements. Correctly reflected. But what is the issue? The issue is that these, but the issue is that auditors spent most of his time to obtain evidence about these matters. Most of his time. Remember these two things. Means they are important matters. For example, they might be material matters. Material, big amounts, for example. Material matters. They might be significant risk of material misstatements. Means such matters which are complex matters, complex accounting issues where judgment is involved. Yes. Significant issues. Key audit matters. Key audit matters. Now there are, so student, they are part of standardized audit report. They're part of that. They're part of that. Now, next. Standardized audit report. Now come the modified audit report. Means that the standard report is going to be changed. Modified audit report. Report is modified. There is some change in standardized report. Yes, there is some change. There is some change with unmodified audit opinion. Unmodified opinion means that opinion paragraph still stating that opinion paragraph is still stating that financial statement give true and fair view of company affairs. Still it is stating that. But there is some other change when this paragraph, emphasis of matter paragraph is added. The first case to audit report or other matter paragraph. Two cases are there. I repeat my words. Report is modified. Opinion is unmodified. Opinion is still same. Now, so what is emphasis of matter paragraph? Why it is used and when it is used? So emphasis of matter paragraph again, it is used to highlight a matter correctly disclosed in financial statements. Again, which matter? The matter which is fundamental for user, financial statement user, that matter. That matter. Now, so emphasis of matter paragraph. So what is the difference? This is also matter correctly disclosed. This is also correctly, so key audit matter. So what is the difference between the both? Question, a valid question arises. A valid question arises. Yes. Now, so students, remember emphasis of matter paragraph. When it is included in an audit report, it is called modified audit report. And this CAM, when it is included in audit report, is part of unmodified audit report. Yes. Now, this is the first difference. Second, emphasis of matter paragraph includes more fundamental matters. More fundamental matters than those disclosed in CAM. Yes, more fundamental matters. And the last thing, still there is confusion that they're similar matters. Then not clear-cut difference. So listen, remember, if a matter is disclosed in emphasis of matter paragraph, it should not be disclosed as CAM. Means it take precedence over that. It is more grave, you know that, than CAM. Now, let us proceed. Let us proceed further. So this is other matter paragraph. Student, examples of amphis of matter paragraph. For example, company has breached a laws and regulation, has been penalized. Company has paid penalty, properly recorded. So amphis of matter paragraph may be used to emphasize it. This matter, highlight it. Possibility is there. So other matter paragraph, this is used to enhance the financial statement users understanding about what audit is. What are auditors' responsibilities? Yes. So you know that responsibility, if to clarify something, it is used for the same. Now, pervasiveness. So matters modified report with modified opinion. So word pervasive. What is a pervasive matter? A matter will be pervasive if it meets one of these three conditions. Any one of these three. One, the effect is not confined to one item of financial statements and is spread across multiple items. Now, for example, they have not consolidated a subsidiary. So when you do not consolidate a subsidiary, so multiple items are affected. Company is not a going concern, but you have prepared financial statement on going concern basis. So so the whole financial statements, their basis is inappropriate. Now, next. So students, so first thing, if the matter is pervasive, affecting multiple items of financial statements, if it is not confined to one item, or a matter will be considered pervasive when its effect is confined to one item that is substantial part of financial statements. You see, just inverse of that. Substantial part. For example, they say company's one investment in asset, which is 70% of the asset. That is pervasive item. More than 70% of assets or revenues. Or this is very important. Company has recorded a profit of 2 million profit. But in our opinion, they have not recorded an expense of 2.5 million. If you record that, it will become loss of 0.5 million. Although, for example, company has total sales of 700 million. Sales. Assets of 500 million. It is a small amount, but the nature is pervasive because it has turned profit into loss. Nature, it's a fact, although it is pervasive. Now, so pervasiveness. The third is it is related to some fundamental financial statement disclosures. So pervasiveness. So three things. Any one of these three satisfied, the matter will be pervasive. Students, auditor has audited the financial statements and has detected misstatements in financial statements. And those misstatements are material but not pervasive. Material but not pervasive. Material, we know. What is materiality? 5% of profit. If item is, it is material. 1% of assets or revenues, it is material. So matter is material but not pervasive. Yes, misstatement. Misstatement. So qualified except for opinion. Auditor will say that financial statement does not give, sorry, in the now basis for opinion paragraph, it will become basis of qualified opinion, where this matter will be explained that this misstatement is there. And in the opinion paragraph, it will become qualified opinion. And they will say, except for the matter discussed below in the basis for qualified opinion paragraph, financial statements give true and fair view of the company affairs. Yes, it will be like that. Next. So the next is auditor is unable to, sorry, if misstatement is material and pervasive, material and pervasive, adverse opinion. What is adverse opinion? Adverse opinion means that financial statement do not give true and fair view of the company affairs. Now, next. Second is auditor is unable to obtain evidence. Second case. The first case was misstatements. Second is auditor is unable to obtain evidence. And the matter is material but not means. Why? Some record is not available, has got corrupted, has got burned. Whatever the situation is, there is some situation because of it is not available. So auditor will give again, if the matter is material but qualified opinion, once again. It is also called scope limitation. This situation is also called when auditor is unable to obtain evidence. Scope limitation. Now, so if the matter is material and pervasive about which auditor is unable to obtain evidence, then disclaimer of opinion. Auditor will say, I cannot, we disclaim, we cannot, we do not express any opinion because we are unable to obtain evidence. So this is audit report. This is audit report. Now, so students, yes, come to the subsequent events. Here we are. Subsequent event. Review. This is basically review. review. So students, subsequent events review. What are the subsequent events? What are subsequent events? The event, this is the year end, this is auditor report. The event which occur, events occurring during this period of time, and those facts, audit report is given, audit report prepared. Those facts which come to the facts which come to auditor's knowledge during this period, and they are related to previous year or after the year end. Yes. Now, next. So, students, subsequent events are of two types. One are called adjusting event and non-adjusting events. Adjusting events are those events for which condition of occurrence exists at year end. They arise. They have some indication, and financial statements are amended. They are adjusted. For example, a court case which is after the year end, but court case was in the court at the year end, so it should be adjusted. Inventory discovered after the year end, which discovered that it is not being sold in the market, obsolete. So financial statement should be adjusted. So because that was in the stock at year end. Now, non-adjusting events. Non-adjusting events are those events for which condition arise after year end date, and they are just disclosed in the notes to financial statement. They are just disclosed. Now, they are just disclosed. Disclosure is provided. They are not adjusted in the financial statements. Students, for example, fire erupted in the plant after the year end. Company announced restructuring after year end. These are non-adjusting. Disclosure is required. So auditor has active duty for those events which occur before auditor report. Means that he need to obtain, plan and perform audit work properly to obtain sufficient appropriate audit evidence about it. Yes. Auditor need to plan and perform audit work. Now, yes, he is checking every event occurring over there because audit is going on. Audit is going on. Second is passive duty. Passive duty of auditor means that those auditor is not doing work over here because he has completed the work. Only those events which come to the knowledge of auditor, those facts, auditor check that only. Now, so that is subsequent event. And the third thing is going concern. Going concern. I'll explain it and then we will proceed to past exam questions. Now, so that is going concern. You know that going concern. Companies prepare financial statements. Normally, we have been studying on going concern basis, but there is a breakup basis as well. When company is not going concern, financial statements should be prepared on breakup basis. Yes, because company is going to be liquid, which is also called liquidation basis. Liquidation basis. Now, so what is the responsibility of management auditor regarding going concern? So it is management responsibility to assess companies going concern, and assess in the form of they produce cash flow forecast for next 12 months. Forecast for next 12 months they produce. And provide evidence that this will be the opening balances in the January, this will be the net cash flow, this will be the closing balance. So every next 12 months they produce. Now, so students, so it is the responsibility of management to prepare assessment and then prepare financial statement accordingly. If company is going concern, prepare financial statement on going concern basis. If not, prepare on liquidation basis. At least 12 month assessment. And the next, sometime it happens, companies are going concern, but material uncertainty exists. What is it? What is material uncertainty? Material uncertainty means that, material uncertainty. For example, company is going wonderful, but all of a sudden, government has started investigation against the company for breach of environmental law. Now, this is material uncertainty. This is material uncertainty relating to going concern. So what? So management has to disclose it. Has to disclose it. Now, that we are facing some issue which may become a problematic for us. So auditor will check whether assessment has been prepared, what are the assumptions behind assessment of going concern, how valid assumptions those are, and auditor has to check whether all the going concern uncertainties have been properly disclosed or not. And auditor should check, this is very important and very important, that are there any going concern problem indicators? Are there any going concern problem indicators? Three types of indicators might be there. One is financial indicator, operational indicator, and another indicator. Financial indicators means these are indicators which give idea that the company is facing some problem related to going concern. Liabilities, losses, negative cash flows. Company doesn't have loan. It is unable to obtain loan. Already loan obtained, that is going to be repaid. And no chances of renewal. Loan is going to be matured. Company doesn't have money. Net liquidity ratios are getting worsened. Profitability is getting worsened. Right? So do you see here financial indicators? Operational indicators, key management, key personnel, key customer, they leave the company. Now, so students, and they are facing shortage of important supplies. Supplies means raw material. Shortage of that. Shortage of that. Now, And of course, competition has increased. Companies' products has become obsolete, product obsolescence. Sometimes it happens that. Other indicators, non-compliance with laws, litigations, or company is underinsured, uninsured. So chances are there. Now, so students, next. This question is tested sometime. And remember, these procedures again have to be written as per scenarios. They say write procedures about the going concern of the company. We will check any covenants of the loan have breached or not. We will review company's cash flow forecast. Discuss the validity of assumption with the management. Review the lawyer's correspondence about any legal issues, legal claims. Review the correspondence between the company and the bank about the financial, any loan to be approved. So you see here, we write the procedures on the same issues. To verify, any of these should not be there. Any of these should not be there. So try to verify that. So need not to be memorized these. Need not to be memorized. Yes, you can read it, grasp it, understand it. And the last one is reporting implication. Reporting implication. What is that? 3 cases are there. Company's going concern assumption inappropriate means company is not a going concern. Company is not going concern. Then financial statements have been prepared on going concern basis. Going concern basis. It means wrong. You know that wrong basis. But pervasive matter, adverse opinion. Auditor will say financial statement does not give true and fair view of the company affairs. Second, financial statements prepared on liquidation basis. Yes, correctly prepared. Unmodified opinion with emphasis of matter paragraph, emphasizing that financial statements have been prepared on alternative basis. Now, second, going concern assumption appropriate, but a material uncertainty exists. Yes, material uncertainty. Company is going concern, but uncertainty is there. Uncertainty not properly disclosed by management. It was their job. It is misstatement. So qualified or adverse opinion. If it has been properly disclosed, a paragraph. What is it? Material uncertainty related to going concern. That has to be added. That has to be added. Material uncertainty related to going concern. That has to be added. Now, next. And highlight this matter should be highlighted that it is properly disclosed. This is the matter. Uncertainty is there. Now, the third case is inadequate assessment by the management. Means we said 12-month assessment minimum management has to provide. If they do not provide, if they provide for 6 months, 8 months, or they do not provide, so it is basically scope limitation. So qualified opinion or disclaimer of opinion. Qualified opinion or disclaimer of opinion. Now it is done. Let us go to the past exam question. So March, June 19, page number 12. Page number 12. 5 to 8 mark question. You see here, it is on the subsequent event. So just to read this all, take 2-3 minutes, then I will solve it. Yes, students, what they are saying. The requirement is here. Now, so the audit is now, so the requirement is explain whether 20x8 financial statement of H company requires amendment. Explain whether it is. So what they are asking? They are asking is it adjusting event or non-adjusting event? Now, so you see here. So what is, so for this period, for this we need to understand it properly. So the audit is now almost complete and the auditor's report is due to be signed shortly. The following matter has been brought to your attention. On 3rd February 20x9, a damage to inventory. 3rd February. What is the year end? It is given above. Year end is 31st December. After the year end occurring, no indication at the year end. Okay, right? And it is arising after the year end. It is an adjusting event. Now, how to write that? How to type that? Like that. Let me write it. So a flood occurred on 3rd February after the year end, after the financial year end, causing damage to property, plant, equipment and inventory of company. Now, what they say next? So they say that the value of damaged inventory was this no scrap value. So these assets have now no scrap value. These assets have now no scrap value. Now, students, yes, the event has no indication of occurrence at year end, and the indication condition of occurrence arose after year end. Yes, as it is an accident. So this is a non-adjusting event. Now, so financial statements of the company for year ended 31st December, what it is? 31st December 20x8. 20x8 need not to be amended. Need not to be amended. Yes. And only a disclosure note to financial statement explaining the assets damaged due to flood needs to be provided. Now, so students, this is how it has to be explained. And there are 6 marks. There are 6 marks for this question. 2 parts are there. So 3 marks for it and 3 marks for it. So now they say that write audit procedures, describe audit procedures which should be performed in order to form a conclusion on any required amendment. So amendment is not required, but on the issue we have to write. Now, student, first of all, Audit procedures. Audit procedures. First of all, what we will be doing? We will be, yes, obtain a list of assets and their carrying values damaged due to flood, damaged by flood, and verify their carrying values from non-current asset register. Yes, carrying value. Yes. Second, obtain the schedule of inventory damaged. Inventory damaged. Physically inspect that inventory. Inventory. To assess whether it has zero scrap value. Yes. Discuss with the management now. Discuss with the management the details of non-current asset damaged and the reason for their zero scrap value, and assess the validity of management's response. Because non-current asset, for example, if it is a machinery, still it has iron. You can sell it by, that, not, you cannot sell it as a machinery now, but it will be sold in the form of, that iron, raw iron. You can sell it. So scrap value should be there. That's why assess their response. Machinery. Now, next. Review. No, not review, because still disclose. Management. Whether they will disclose the matter and its effect in the financial statement notes, yes or not. So enough, 4 are enough. So it is done. Is it clear, students? So matter, issue, is that clear? March, June 19, question number 18D, yes. Now, let us proceed further. So the next is September, December 18, okay, 36. 36. It's last part. Read it, please. Very easy. Now, so discuss the issue. Describe the impact on audit report of adequate and inadequate. Recently we covered it. 5 mark. 5 mark. Now, so students, discuss the issue. During the final audit, the finance director has informed the audit team that Jasmine Company's banker will not make a decision on the renewal of overdraft facility until after the audit report is signed. The auditor engagement partner is satisfied that use of the going concern is appropriate. Yes. The director have agreed to include some briefing disclosure info statements, and teams have to assess the adequacy. It is basically material uncertainty related to going concern. Yes, it is basically material uncertainty related to going concern. It is. So you know that. So if it is properly disclosed, what will happen? Properly disclosed, adequate. Disclosure is adequate. You can ask this question by WhatsApp as well, dear. Do not interrupt in this way. I am discussing something. I thought this is some question relating to the question. Question is about this question we are doing. Okay, don't worry. I am here to facilitate you people in any way. Okay, whatever you want, facility, I will try to do that. Don't worry. Okay, now. So where I was. So if this disclosure is adequate, if this disclosure is adequate, remember, auditor will give unmodified opinion with material uncertainty related to going concern paragraph. That will be added. And reference will be added to that. It will be included after the basis of opinion paragraph. Second, if it is inadequate, then it is misstatement. It is misstatement, material, but not pervasive. So a qualified opinion will be required. It will be given. Qualified opinion in this case. With basis of main paragraph explaining this matter in appropriate disclosure. And with qualified opinion paragraph, yes, with that opinion now. I hope it is clear. 5 marks. So how the answer should be written, I can show you. I can show you how answer should be written. I'm not going to type it. It is in front of you. You can just go through it. I don't think there should be a problem. Now, so you can go through yourself at home. The next is March, June 18, question number 50. Question number 18, page number 50. Yes, page number 50. Here it is. Similar issue about audit report. You see, discuss the issue and describe impact of audit report. Students, these 5 marks such easy to score, but the problem is that students take it casual. These 5 marks, they take casual. So what they are saying, during the audit, the team discovered that intangible balance include 440,000, one of the 9 new health product, which does not meet the criteria for capitalization. So no adjustment. This is misstatement. 440,000. We will calculate its material. Discuss the issue. Now, this is, student, this is the matter which is for which we need to calculate and discuss the materiality. So now how to solve it? I will type its answer. I will type its answer as well. Now, March, June 18. March, June 18. Yes. It is question number 18D. 18D. Question 18D. Yes. Here it is. So its answer we will be typing. We'll be learning how to write answer for audit report, such question. So one of the 9 products being developed does not meet capitalization criteria of IAS 38. So it should not be. So cost incurred on that product should not be capitalized. Rather, it should be expensed out. It should be expensed in profit and loss. Loss. Now, the amount is 440,000 and is 440,000 divided by what is the asset, or yes, we can take. So we can take profit 6.4 million. 6.4 million. That is equal to 6.9% of profit. And we can calculate for assets as well. 440,000 divided by Asset 37.2 million. 37.2 million. 1.2% of assets and is material to financial statements. It is material to financial statements. Yes. Now, next. So, management of the company should remove it from assets and charge it to profit and loss. And if they do not do so, assets are overstated by a misstatement which is material but not pervasive. Yes, not pervasive. So, a qualified opinion will be given by auditor. Now, students, you see here, there are 5 marks. 1 mark for it, 1 mark. 1 mark for materiality calculation. 1 mark for it overstated by a misstatement. Yes, should remove it and charge it. Yes. So 1 mark for it, misstatement. Now, and next, a basis for qualified opinion would be needed after the opinion paragraph. Now 1 mark for it. 1 mark. But 1 mark still remaining. This paragraph will explain the material misstatement regarding incorrect treatment of research and development cost. And its effect . So 5 marks complete. You see how one sentence, easy sentences, straightforward sentences. But what does student do? Student in quick, they write 2 lines, qualified, not pervasive, material not pervasive, except for qualified opinion. So 2 marks maximum you get. How marks are properly distributed? 1, materiality, what type of opinion, how paragraph, what should be the wording of that. So these are easy marks to score. Don't ignore it, because failure and the pass Differences of few marks. Sometimes students fail at 46, 47, and they wish they get 2, 3 more marks. Now, next. So the next is September, December 17. September, December 17. Question number is 18, part D, page 62. Page 62. Similar question, you can see. Misstatement is there. This misstatement. Similar way, 5 marks you have to gain. Provisions, you have to discuss how it should be recorded, what should be done, materiality, what should be the audit report, how it should be drafted. 5 mark. Is it clear, students? Is it clear? Tell me. Tell me, please. Is it clear? Okay. Now, so this audit report and review is done. Take 12 minutes break. Please refresh yourself. Then come back for ethics. That will be the last topic to be discussed today. We will be discussing that. And remember, most likely we have class on 24th or 25th November. I will communicate via email in the evening. I told you yesterday. Okay? For MTQs. So see you after 12-13 minutes. Yes, students. The last thing for our crash course 3 days, the last topic is here finally. Yes, ethics. These are the 5 fundamental principles which we have been studying since long. So I'm not going to repeat these, what they actually are. So you know that integrity, objectivity, competence, confidentiality, professional behavior, they are here. Actually, issue over here is in ethics, the first thing is knowledge in the ethics. Because ethics is being tested in the last 5 exam attempts. It is being tested in MTQs. It has not been tested in the scenario based question. It has not been tested. So that's why, but it can be tested. It can be tested. So the knowledge, the detailed knowledge is required. Detailed knowledge is required from your any book, any notes, whatever you are doing. Ethical threats, safeguards, what are the type of threats? So detailed knowledge is required. So I have given over here small overview. So because this is a type of revision, so students remember there are some safeguards in general. When there is self-review threat, what is self-review threat? Self-review threat arises where you have to review and report on the credibility of your own work previously performed. The work you have performed previously, you have to review that and the report on the same. So in that case, they say that use different teams. Use different teams for the work. Use different teams other than audit team. So that you can perform work properly. And the second is, yes, if there is familiarity threat where the person loses skepticism, questioning mind is lost because of relationship, family relationship with someone in the client or long-term relationship. So remove him from audit team. Discuss with those charged with governance. And if there is pressurized, auditor is being pressurized. So you simply politically decline the audit. And yes, these are the safeguards. But there are some self-interest threats as well. I am saying it again. You need to revise ethics very well from your detailed notes or any book, whatever you have covered. Now, next. So, self-interest threat, where personal benefits of auditor are attached. You have shares or bonds of the client. You are having business with the client. So, it is prohibited to do business. Sell off that business, sell off the shares, or you should be removed from audit team. Or sometime your overdue fee is there. When overdue fee is there, to delay the start of audit until that recovery is previous fee. So when we provide multiple services means that when we provide audit service plus taxation service plus preparation of financial audit plus any other service, self-review threat arises. Auditor should not assume management responsibilities. Remember, if client is listed or other, and the service which their client is requesting us, other than audit, that has impact on financial statement. Service what they are requesting us, that has material impact on financial statements. So this service cannot be provided because we are the auditor. Self-review threat will be severe. If it is impact is immaterial, then it is allowed. With safeguard means safeguard same, different team, review the work, inform audit committee. For other clients, it is allowed. You can provide this service. Now, so scenario. I need to just check whether scenario is available here. Just 1 minute, please. I need to check whether do we have any scenario. Yes, here is one scenario available. 5 mark, one pass paper. And you see it is 6 attempts back, 6 or 7 attempts back. Okay, now, so we will talk about it. So how scenario is solved? Explain the threat. Explain the threat means that how it is arising, how it will affect auditor, and give safeguards. So page number 60 of the course notes. Again, this is not part of our handout right now. It is something old, March, June 17. It is not part of handout. So that is 60. Yes, here it is. This is the issue. Conflict of interest. Conflict of interest. Again, it is based on the knowledge. Explain the safeguard which HALE company should implement. What they asked? Question is safeguard. Only safeguard. They have not asked anything else. To ensure conflict of interest is proper. 5 marks. Read it please, so that we can discuss it properly. What they are saying, HALE company has recently accepted the audit engagement of new client, Edmond, which is the main competitor of Comet Publishing, which we are auditing right now. The finance director of Comet Publishing Company has inquired how HALE company will keep information obtained during the audit confidential. So 2 audit clients, Comet, we are auditing already. Their competitor is Edmond. We are auditor, HALE. We are their auditor. They have contacted us. How to keep that confidential? So first of all, the requirement is that how to ensure. Yes, now first of all, inform the and obtain the consent from the management of both companies, whether HALE company can act as auditor of both. And if they give consent, then it can be continued. Otherwise, they cannot audit both at the same time. First thing is obtain the consent of both managements of both companies. Safeguard. Right. Second, if they allow, arrange different audit team for both clients. Second safeguard. Third safeguard, introduce strict procedure for confidentiality of information, securities of the files, password protected files, which for one team so that it is not accessible by the other team. Fourth point, confidentiality agreement must be signed by each team member working at both clients. Confidentiality agreement. Fifth point, because 5 we have to tell. Fifth point, close monitoring and supervision of both teams, that whether they are following these safeguards, ensuring confidentiality or not. So 5 done. I hope it is clear. So this is done. Now students, we have MTQs remaining about it. All right, we have MTQs remaining about it. I think we should do that on the one day we have decided already. What do you say? So that's enough. MTQs, so, and for that purpose, you need to revise the whole ethics. So you can revise it till 24th of November, the whole knowledge, and of course, you can ask me questions as well. So, just a minute. I have sent you the MTQs handout as well. It is from the past paper, the whole MTQs and MCQs. These are all past paper. Yes, June 15, one past paper, second past paper, whatever is available. So we will be doing it. Plus, I will try to find some additional as well. Okay, students? Do you agree? That's enough for today? Yes, tell me, please. Yeah, so students, that's it. So kindly start revising it. Practice hard. And we are going to meet on either 24 or 25th of the November once again in the evening. Things will be communicated to via email. Okay. I have tried my best to deliver the best I can do in this session. All the best. You know that. See you. God bless you. Goodbye. Goodbye. Thank you. Thank you. Goodbye. Goodbye.